Welcome to this explainer on the GoldMining Guardian account. Today, we're opening up the books for our Week 20 performance review. We're stepping completely away from the typical financial hype today and diving straight into the cinematic reality of algorithmic market execution. What you're looking at is a live, transparent, multi-major diversified trading journal. No promises of overnight riches here, just a documented journey of mathematical progression, real market data, real execution, and real risk management.
Week 20 Performance Review.
This explainer focuses entirely on Week 20. We're going to unpack the exact market conditions and mathematical outcomes we saw, but first, context is everything. It's so easy to get lost in the noise of a single week, but successful algorithmic trading? It's a marathon, not a sprint. We're contrasting our massive 74.08% lifetime growth against a meticulous, hard-fought 0.69% gain from this week. This really grounds us. Those massive lifetime percentages are built exactly like this, on the back of tiny, consistent, weekly fractional gains.
74.08%. That's our total lifetime growth since we launched at the start of 2026. It's a highly impressive mathematical achievement, but it absolutely didn't happen by accident. It's the result of strict algorithmic discipline. So how exactly does an algorithm protect and build that kind of growth?
Well, before we answer that, let's strip away the marketing hype completely. This is a cent account. We originally started with a deposit of 2,500 cents, which is roughly 25 US dollars. So all the balance and profit figures you'll see today are denominated in cents. Why do we do this? Because it allows us to test real market execution and real risk dynamics in a completely controlled environment. We're focusing on percentage progression and systemic stability, not inflated dollar amounts.
The visual story of that growth is crystal clear when you look at the lifetime balance and equity curve. The blue line is our realized balance, our closed profits. The purple line is the equity, the actual floating value of the account, including any open trades. Notice that steady upward trajectory since January 2026? The algorithm consistently pushes the balance higher, while the equity line closely tracks it. It dips occasionally when positions are open, but it always mathematically recovers.
Looking deeper into those lifetime stats, we've got a net profit of $1,823.75. But the metric I really want you to focus on here is the recovery factor, sitting at an incredibly strong 9.76. In algorithmic trading, this measures a system's ability to bounce back from drawdowns. A number near 10 means extremely high long-term resilience. The system doesn't just make profits, it aggressively defends them and recovers rapidly when the market pushes back.
Section 1. Week 20 Performance Review, Navigating the Market.
Transitioning down to the micro level, here's our Week 20 snapshot. The system generated a highly precise gain of 29.10 cents. We also secured a very healthy profit factor of 2.72 for the week. That means the system generated $2.72 in gross profit for every single dollar of gross loss. We're keeping our focus on proportional mathematical gains here. A 0.69% weekly gain might sound small at first, but when you compound it consistently over time, it's exactly what builds that 74% lifetime figure. To truly understand this week's performance, we really need to define floating drawdown. It's simply a temporary gap between an account's realized balance and its fluctuating equity, caused by open positions during market volatility. It is quite literally the cost of doing business in algorithmic trading. You cannot capture market movements without exposing some capital to temporary pressure.
Notice how on the right side of the chart, as that blue balance line steps up to secure the week's 29.10 profit, the purple equity line experiences a noticeable downward separation. That gap right there? That's the temporary equity pressure manifesting in real time. The algorithm is holding open positions against a strong market trend, patiently waiting for the right mathematical opportunity to resolve them.
Viewing that pressure from another angle, the green line shows our slow, steady 0.69% growth for the week, but that red line tracks our drawdown spikes. This week, we saw a maximum drawdown of just 0.44%. Those red spikes tie directly to periods where sudden US dollar momentum and treasury yield movements temporarily squeezed our equity. The pressure was real for sure, but mathematically, the system contained it beautifully.
Section 2. Multi-pair diversification in action, chart forensics.
So how exactly did the system contain that pressure? The engineered solution is multi-pair diversification. But before we look at the individual charts, we have to understand the macroeconomic forces driving the market this week. The environment was totally dominated by changing U.S. inflation expectations, erratic movements in treasury yields, and a resulting wave of broader U.S. dollar momentum.
When the USD flexes its muscles like this, it sends shockwaves across all major currency pairs.
Let's see how our pairs reacted, starting with the Euro-USD on the 15-minute chart. As the US dollar gained strength, the euro fell. See those red arrows? Those are the algorithm's sell positions. The system successfully identified the macro trend and effectively captured this downside momentum, systematically scaling in and out to generate the necessary profits to counterbalance pressure elsewhere.
Now, the USDJPY action was the primary source of the equity pressure we just talked about. Notice this aggressive, volatile upward climb. The algorithm was heavily tested here as the yen weakened dramatically against a very strong dollar. However, intense volatility creates both pressure and subsequent recovery opportunities. The system dynamically adjusted its grid to absorb the climb while hunting for those inevitable retracements.
While the yen was causing pressure, the Canadian dollar was helping to steady the ship. On this USDCAD chart, the blue arrows represent buy positions. The algorithm successfully rode the upward wave created by USD strength, banking profits along the way. This is diversification perfectly at work. When one pair gets caught in temporary drawdown, another pair is actively capturing profits to keep the overall portfolio equity stabilized.
The absolutely crucial takeaway here is synergy. During week 20, EURUSD captured downside momentum, USDJPY managed intense volatility pressure, USCAD provided portfolio stabilization, and USDCHF also chipped in to balance things out. They all played distinct, non-correlated roles. By spreading the risk across 4 different geographical and economic zones, the algorithm massively reduces its dependency on any single pair behaving perfectly. A huge observation from this multi-pair strategy is how the algorithm managed its position sizing. Despite the highly erratic behavior of the US dollar this week, the system maintained strictly controlled exposure. It didn't panic, and it absolutely didn't over-leverage to fight the trend. It stuck to its mathematical parameters, proving that conservative risk management is way more important than aggressive profit hunting during turbulent times.
Our transparent trade log for the week reveals exactly how this gets done. Look at those lot sizes, 0.01, 0.02, tiny, highly controlled micro lot execution. These are the incremental, seamless trades that fought through all that volatility to achieve our 29.10 cents weekly profit. It's a game of precision, not power.
Bringing it all together, here is a final, transparent look at our current account standing as week 20 comes to a close. Our realized balance sits at $4,262.93. Our floating equity is right behind it at $4,000.29. The system weathered the storm, secured a fractional profit, and remains in a very healthy, recovering state as we head into next week.
Zooming back out to the big picture, we always want to remind you of the overarching mission here. Our long-term target for the GoldMining Guardian is 10,000 cents, effectively multiplying that original 2,500 cent deposit by 4. We're applying a patient, documentary-style approach to algorithmic compounding. We're not rushing anything. We're just letting the math do the heavy lifting, week by week, month by month.
Algorithmic trading isn't some magic wand. It's a tool of statistical probability. This explainer showed you how diversification absorbs shock and how small percentages compound into massive lifetime growth over time. So as we close the books on week 20, ask yourself, are you building your portfolio on hype, or are you building it on the solid, undeniable foundation of mathematics? Remember our core motto: real accounts, real risk, real progression. Thanks for watching and learning with us today.